So it looks like we are going to be in for more volatility as it becomes clearer, if it does, what the impact of these tariffs will be. Our guest says, yep, you can look for volatility throughout the remainder of the year. We are joined by Brian Vendig, Chief Investment Officer at MJP Partners. Thank you very much indeed for our MJP Wealth Advisor, sorry. Oh, I'm sorry, Dec, you very politely didn't correct me there. It's Dec Mullarkey, Managing Director of Investment Strategy, Asset Allocation at SLC Management. I beg your pardon. What is your take on volatility?
All right, good morning, Andrew. It's definitely going to be volatile. I mean, certainly, it was interesting coming into this, into today all week. Investors, certainly in the S&P, seem to be taking profits and just backing off because they recognize, okay, August 1 was a critical day in terms of what's going to happen there. And even though earnings were quite strong and some varied as well, certainly across the Mag 7 and everything, when this actually hit, and it has, investors are going to have to get their head around, what they're going to do next. Now they do have a week, so there's to negotiate, come back, try to solve things, and companies will try to also get as much product in as possible on that. But there's no question this leads to volatility. Now markets have been less volatile in the response as we go through with this tariff/Trump fatigue in a way. But this one is kind of a getting back to kind of Liberation Day levels with all that's been pushed out there. So it is undermining a lot of what countries are trying to do and how they're trying to get on side with this. So the market has a lot of processing to do around this. But I think they're at this stage where they're a little more mature about it. And certainly what we saw in earnings is that companies so far have been somewhat successful about coping with tariffs. But we shouldn't be lulled by that too much because it had loaded up on inventories in advance, and that's what was coming through. And therefore, you didn't see as much cost pressure. But the longer this goes, and the more it's unresolved, those effects will really, really start to come through in the numbers and start to pinch earnings. So we've been getting away with a bit of a freebie up until now, and we'll see where this volatility goes from here.
AI, though, still a bullish theme in the market?
It absolutely is, and we saw that coming through, and there's variations across that. I would say the Mag 7 has collapsed to what I would call the AI trinity, which is the top three: NVIDIA, Microsoft, and Meta. They've outperformed, and then you had some stragglers. With Amazon, even though they're posted pretty decent earnings in that, they actually did get penalized because their AI efforts are not showing as much flow through to income as the other players. And Google is trying to play catch up because they have stalled on, or they're trying to transition. Okay, what are they going to do with their search engine, and how is that going to perform in this new environment when AI is taking over? And then when you look at Apple, their strategy on AI is still floundering. So we have a mixed bag across AI, but again, the strongest players that are showing the most progress, they're getting rewarded. And then there's a real focus on the others who are spending a lot, and Amazon included, but not seeing as much throughput. So that's where we're at on this, prove to me that you actually have a real AI product and opportunity here.
Just swinging back to tariffs for a sec, and you may have touched on this, sorry. The assumption here is that companies will succeed, U.S. companies will succeed in passing on tariffs to their customers?
Yeah, that is the expectations. You see it in analyst forecasts. You see it in projections of margins and where those are going to land at the end of the year. So that will be the issue. I mean, some sectors will have more pricing power than others. And I think there'll be a phase, and that's what we saw before in COVID, is that companies are they'll adjust as much as they can with their cost structure and maybe substitution or whatever, and then flow through to the customer. But everything we've seen, certainly in history, shows that the consumer at the end of the day pays for a lot of that. Some have success with pushing back on vendors and their suppliers, but the consumer definitely will start to see it. And that is more a second half of the year effect. Even if tariffs were to hit like say on what's on the table right now, as long as boats have left their destination within a week, it takes sometimes 2 months to get here. They still will factor in their oil prices rather than the increased ones.
So you do feel that we've got more pain coming in terms of the impact of tariffs, because of course, there is latency. Ships take a long time to arrive. Things have to work their way through the system.
There's no question. There's absolutely no question. And it's not encouraging when you see the job market and the numbers we posted, and you see that consumer sentiment is starting to drop. That's already showing up. So what these tariffs will do, I mean, we talk about the inflation effect, but there's the demand destruction that comes with that, is that literally you're just reducing, people have to pay more for a smaller basket of goods. That activity is going to drop. So we're still figuring out the effects of that. Again, markets continue to be somewhat optimistic that all of this will get worked out and we'll settle down at a tariff rate that's going to be, obviously still high, but not as high as what's projected right now. So again, a lot has still to play out, and we'll see where all that goes. But it's definitely pretty uncertain where we are right now.
If a client came to you or an account came to you and said, look, markets are at record highs, do you think I should cut back radically on my stock exposure for 6 months until we get more clarity on tariffs? What would you say?
It's a good question. I mean, I'm always have been in my career one of those people that feel you should stay fully invested. If you think long term, your positioning is good and those assets are going to perform. And I certainly feel that way about the stock market as an example, because it's hard to time the ins and outs. I mean, you have to make two decisions: time to get out, the time to get back in. And those are hard to game out. And equity markets in particular are notoriously efficient about repricing. Once risk starts to drop, they really start to run back up. And it's sometimes you're trying to catch up and get back to where you are. So that's the challenge.
That's the frustrating thing, isn't it? Yeah.
It is.
What about bonds? Bonds tend to be a tricky thing to hold when inflation is higher than investors want. What is your take on, say, holding a US 10-year bond right now? Pretty constructive. Now, and your question's a good one. That sometimes they can be tricky, particularly if inflation is in the mix, and it's certainly there in the U.S. The rest of the world in much better shape in terms of getting inflation under control. Therefore, their bond dynamics should be more stable. The U.S. does have that tricky issue where trying to figure out what that inflation effect is going to be, how it's going to affect a 10-year rate. But I still think in the U.S., you could sit in short term and do pretty well. So that's where I would say is shorten up your duration, say in the U.S. But in a lot of other markets, because the inflation environment is a lot more stable, they're more encouraging if you wanted to go out and take on a little more maturity. The U.S. probably stay in the short end, and then obviously when things settle down, you can move from there back to your desired position or target.